I'm Carol, I'm the editor of Project NOSH. Good to see you guys here today. Thanks, Jeff, for that one. When I talked to folks in the industry, I was just so excited to get started because this next speaker is going to be amazing. They talk about how there's just so much more capital that's available and so many more groups that are looking to invest in emerging food and beverage brands. And in, for example, the past week alone, I think we were told about 6 different rounds of funding that had closed for brands. And certainly that's not an average week, but you know, the pace is just picking up. But when you're ready to take investment, you need someone in your corner who can sort of play matchmaker. And Nick McCoy is at Whipstitch Capital, which in their own words, makes the right deals happen at the right time. Completed transactions led by the Whipstitch team include Blake's, Mediterranean Snacks, KeVita, and investments include the recently announced Peeled and Red, as well as JC Pie Pops. So let's welcome Nick to the stage as he finishes up his snack. There we go. Oh, yes.
That's good. I'm good. I'm ready. Excellent. Thank you. All right, so first thing, I have to make sure the clicker works because I'm really bad with clickers. Okay. So my name is Nick McCoy, and I am the co-founder of Whipstitch Capital, and my partner, Mike Burgmaier, will be here tomorrow. Mike and I have worked together about 10 years, and all we do is kind of healthier, innovative food and beverage, deals. We advise companies on raising capital, call it $5 million or higher, and also on selling or larger companies on buying as well. I was in a conversation the other day with a good friend of mine who was in town visiting a sick niece, and she was asking, kind of what gets you out of bed in the morning? What excites you about this industry? Because this is all we do, and there's tech, there's healthcare, and there's a lot, in some people's minds, sexier industries out there. But you think about it and you say to yourself, what it really is there's so much change going on. And in this industry, every single person in this room with the product that you have is actually making a material change on a category, which I think is just so fascinating. I mean, you can't do that in tech. You can go and you can create a great software as a service, and you can make data flow faster, or help corporations save money by having less people, but you're not changing the way people eat. And that's just so fundamental. And making people healthier and bringing options to the market that aren't there. That's where my passion is, and that's why I really, really like connecting with entrepreneurs and watching them grow, and that's why we do what we do. Carol talked about some of the deals. I'm just going to kind of skip the commercial here and get into the meat. But yeah, we've done about 50 transactions, Mike and I, since we started working together. Okay, so Mike wrote an article here. That's the title of it. But basically, what we're talking about here is that there's a lot going on in this industry. And right now, you'll see in some of the deal slides I have later on, the strategic investors are getting more and more active, and there's obviously tons and tons of financial investment as well at all check sizes. But on the right there's kind of a list of all the strategics with the groups they have, and kind of what the structure of the group is. There are some that are basically investing for legacy IP in their company, like Mars. There's people like General Mills at 301 that are looking at categories that they just don't play in at General Mills, like Tio Gazpacho's drinkable soup. They don't have beverage, so that's kind of something they're learning on. And then there's the classic big bevcos that do the two-step deals, like KeVita that we just sold to Pepsi, which is just a very kind of baked-in model at this point. So if you step back and you say kind of, why is this industry so exciting, and why is so much money coming into play, and what's really happening? What's really happening is that the consumer is demanding change. The retailer is actually responding and being forced to respond because they obviously are backed in a corner with online and other threats right now, and they're actually doing a pretty good job. There's some real innovation in retailers. I like what I'm seeing. And that's all of a sudden bringing the interest from the large CPGs who are suddenly losing their market share and losing their shelf space to new upcoming brands. And of course, that's going to drive institutional funding. And this cycles. And the cycle is accelerating, and that's what's really, really exciting. You're seeing more and more deals where companies are getting bought by big CPGs and more funding's coming in. And I don't think this trend is going to stop. There's still a lot of legacy brand market share to grab. It's not all going to go away, but there's going to be a good chunk of it in the next 10 or 20 years. Just some recent highlights. What I thought was interesting on this, there's obviously been a lot of deals, but for the first time in a while, there's actually 2 companies on this slide that are private equity-backed companies that are rolling up multiple brands. Like Panos Foods buying Walden, that's an example. So that's a buyer that's not a big CPG that's buying something for their kind of marketing machine. It's actually a financial buyer that may buy 10 or 15 brands and put them all together. And that's great to have in the market, because when you go to sell your company one day, that's another buyer that's going to help bid up your price. And I really like to see it. I think it's healthy to see financial buyers that are kind of being aggressive like that. And the second one is Savos, which I think everybody saw the Rayo's announcement the other day. That was their second purchase after Michelangelo's. That's on a little bit larger scale than Panos, backed by Advent International. But lots of deals, both in the kind of the food tech and CPG. And in the financing side, what's interesting here is out of the 27 deals there, 6 of them are strategics, which is, if I was sitting here last year doing this, it might have been 2 or 3. So I think that's actually really interesting. And the strategics will invest alongside of financials. But again, I think this is very healthy. So kind of what do you want to do now to get money? I mean, that's what this is all about, right? Is how do I get funded so how I can grow and get big? Because it's really hard. The first thing is, every investor that you talk to, they walk in the room backwards. They're thinking about the exit, your exit. So when you start talking to them about, raising 100,000 or $1 million or 10 million, the first thing they're thinking of is, okay, when am I going to get my money back, and how much am I going to get, and what are you going to do to get me there? All right. I didn't realize that guy was so animated. So kind of the core truths, the core things that they look at here. Your brand, is it extendable? What does it mean? Is there equity value in it? Is it something that is too narrowing or too big? I mean, Skinny Pop is an excellent brand for what it was, but you can't have a brand that's that narrow, in most categories. I mean, they crushed it. They have huge margins and, multi-$100 million of sales, and all they can do is low-calorie popcorn, but it works great. Most people have to have a broader brand. Good growth. Right now, these kind of headline deals that you're seeing, kind of the Justins of the world and, these kind of big price deals, those companies are growing at 50% and above. So when somebody says really good growth, that's it. And that's got a heavy velocity component. We'll talk about that in a minute. So velocity is basically your sales per SKU, per store, per week. So if you've got, 2 SKUs in Stop and Shop and you're selling, 4 units a week in total, your velocity would be 2. And the most important thing when you're growing is that velocity number is going up. So if you try to raise money for your company or you sell and the velocity number is going down, investors look very badly at that. It's actually bad to grow and have your velocity drop. And it happens sometimes because people will get really excited and they'll say, Kroger wants me, and Walmart wants me, and Target wants me, and they'll blow the product out to 30,000 doors, and nobody knows your product yet. So all of a sudden, the little bit of product you're selling gets cannibalized by all these other doors, and it drops because it's just not ready yet. So that's really an important thing. Don't grow too quickly until you start seeing your velocity go up. We'll talk about how to figure that out too in a minute. Gross margin is really important. We'll talk more about that. The market, category, and leadership. So on the brand side, take a step back and say, am I limited? So can I change my product? Customer tastes, the preferences. You have to constantly grow. And you're basically, when you're selling to an investor, you're kind of selling off the future. So you need to sell somebody on, this is where my brand can go and how big it can get. And this is my vision. And particularly when you're really early stage, because people are betting on you and they're betting on your vision. Honest is just a great example. So this is something that basically started with a tea bag and ended up in Honest Kids. And it's the Honest brand can go a lot of places across beverage. And it's obviously so on trend because, not that Coke isn't honest for what it is, but it's a whole new category of, kind of healthier, better for you beverage. Okay, so when I was talking about figuring out your velocity gains, this is what I'm talking about. And this chart looks a little bit geeky, but this is actually really important. If you look at the green on the left, that's kind of your baseline velocity, your sell-through. And then you run a promotion, and that's that kind of blue spike. And then you see the green to the right of the blue spike is higher. So this is what you want to do. You want to figure out how to promote your product so that your baseline goes up after the promotion, and then your next promotion's even higher too. And it's kind of hard to do because at Whole Foods it might work really well to do a 15% off, or 25% off TPR, or maybe demoing works there, but it's not going to work at Stop and Shop, or it's going to be too expensive there. So kind of figuring out how to promote your product and build velocity is important because if the investor's giving you money, that's what they're giving you money to do, to promote product, build velocity, and grow that way. Margin and cash. So gross margin should almost be looked at as a funding source. It's that important. Because when you look at it, the amount of money you have to grow your company is your gross profit, actually really less your freight out, and all the money that you raise. And that's what you get. I guess debt too, but you're not really going to get that when you're early. So, this notion of I'm going to underprice my product and catch up with volume can be very, very expensive because you have to raise that much more money, right, to do it. So if you can get a good gross margin in the beginning and make sure you account for waste and some of the excess freight that you're going to have to pay when when you're small and Amazon's getting 20 cases at once and not a pallet, and all the things that kind of are unexpected, spikes in monk fruit and things like that. There's a lot of unexpected. So when you kind of lay out your standard cost and you get to this 40%, the reality is you might really be at 30 until you get to be a couple million and you've really gotten to know your co-packer well and things are going swimmingly. Some other things, market leadership. This is important. Knowing your market, knowing how big it is. When you come up with the product idea, you're kind of saying there's a white space out there, and I see it. And for KeVita, it was a sparkling probiotic that was basically kind of like GT's kombucha, but it kind of tasted better, and it was more approachable for a different market segment. It was something that would work better in conventional grocery, and it worked really well. They eventually expanded into kombucha and some other areas too. But knowing the vision for that white space and that white space is actually growing and that you can kind of grow that category within a category, that's what investors want to hear. So, and that could be anything. I mean, if you look at jerky right now, you've got Crave, which is already kind of sold as a healthier jerky and it's got more flavor. But now you've got Chef's Cut, right, which is another white space because they kind of cut cross grain. I don't know if you ever had it. It's more tender. It's kind of thicker cuts, looks more hand cut. It's a little more marinated. You've got, Country Archer, which is grass fed. That's another white space. So you kind of look at it, and all of a sudden, this market has opened up, and there's kind of 5 or 6 ways that you can niche in there and succeed. This slide is really busy, but after this, you should take this and put it up on your wall, and when you make decisions, refer back to it. Because these are the kind of dimensions that every investor and strategic look at when they look at value. This is what really drives value. Obviously, more revenue is better. The bigger that you are, the more established your brand is, the less risk it is for a strategic to buy it. A large strategic wants a brand that can be $100 million or more. And that's because that's what they're made for. And they're marketing machines. They do TV ads. That's what they're really good at. And it doesn't work well if you're only $10 million. Gross margins, obviously that's very important. If you're selling a product with a 20% margin in a category where the margin's usually 40, it begs the question of why aren't customers willing to pay more? Or, what are you doing? Do you have to trade spend that much to get the product out there? You know what I mean? There's something wrong. So obviously a strong gross margin, considering the category, is important. And it varies a lot across category. Growth, especially velocity driven. Capital efficiency, this is important. So how much did it cost you for every dollar in revenue that you gained in the last year? So if you are a $5 million company and you went from 2 to 5, from last year to this year, and you only spent $1 million doing it, that's pretty capital efficient. If you spent $5 million doing it, that's not. That tells an investor they're going to have to spend a lot of money to get you from 5 to 20 and sell you. It's like your report card. So capital efficiency is really important, and good gross margins help with that. Brand extendability, we've kind of talked about that. Simplicity. Customers are smart, but they really don't like to be educated on the store shelf. So if you have something that's really simple that somebody can get in 2 seconds when they walk by it at Target, that's ideal. If you're in some new category that nobody understands, that has some functional benefit nobody's going to understand unless they Google it 5 times, it's really difficult. You need to simplify somehow. Price point, you need a premium. In most cases, an innovative or better for you product is going to have a premium, but it can't be so much that it's not accessible to the big market. There are some exceptions, like Suju was $9 a bottle at first, $10, and it flew. But you notice that they've moved down into the elements and the kind of lower price things now to move more conventionally. Frequency of usage, if you're in snacks and beverages, certain snacks and beverages, you buy it, you eat it before you go home, that's the best. If you're some kind of baking mix that goes on sale once a year and people pantry load and it spoils in your cellar, that's the worst. Something that's really slow consuming. So you will get a bigger revenue multiple when you go sell your company one day or when you get investors in if people consume your product faster, because that means they're going to buy it more often, they're going to be that much more connected to it, and there's a lot of brand disloyalty out there, so you want that. Category, obviously important. Every category has some really interesting things going on. 10 years ago, nobody wanted to do a frozen deal. Now frozen's pretty hot. There's a lot of change in frozen, and that's sweet frozen, that's meals, everything. Center of store, that was kind of a sleepy place, right? And then Sir Kensington's gets bought by Unilever. Now everybody's talking about center of store. There's, every category is going to have change, but obviously it's got to be a category where there is an opportunity, back to the white space point. Customers, obviously you want a growing demographic, distribution and team. So we do a PowerPoint for every Expo West, and we have 11 trends in it. And 2 years ago, we put out our 11th trend. This is the one we got the most feedback on, which is the long tail of food. And that's the concept that a customer, using technology, will be able to find their product that they want and be willing to pay a significant premium for it on a very niche basis going forward. So people will get smart. And in the future, you won't have to be a $100 million brand to be profitable and exist. Right now it's really hard to be a $5 million brand and make money. But you can do that if somebody's willing to pay you a 50 or 60% margin because you've got a niche product that serves a certain population that wants that product, and they can get your product either on Amazon or directly or whatever, or in certain niche stores where you can sell it and you can get enough pull-through, and you can be cash flow positive, and that will happen. So it's really, really interesting. You're starting to see some products do that now. And usually they're heavy online sales. I've seen some bar products that are very profitable at a young age because of that. So my partner Mike wrote an article for BevNet. A few years ago, and the idea was if we look at all the common things of the companies that are getting funded and the companies that are getting sold, what's there, right? What's common? So one is going deep and not wide. And that is, don't do 30,000 doors before you know what you're doing. Go deep and prove your product out and sell that proof. White space, we talked about that before. Growing open area. Capital efficiency. The had one, want another. That's, you buy it, you eat it on the way home, you're stopping and buying another one the next day. Making money counts. EBITDA is great. I think growth is worth so much more than EBITDA in this market right now that most people are not going to be EBITDA positive between now and the time they sell. I know that sounds really scary, but it's true. So I think gross margin is a much, much better metric of profitability. That's where the focus should be. Fueling growth. So whenever you're raising money from an investor, the focus is, when they say, well, what are you going to do with the money? And the bad answer is, well, I'm burning $1 million a year because I have to pay myself and I have to pay my mother. And no, it's the $1 million is going to grow the company, and it's going to pay for slotting, it's going to pay for and go down the list. So that's really important because they don't want to fund burn. Creating permission to go across multiple categories. Again, a brand that kind of expands or is expandable, and then a success obviously with the team, bringing the right resources. And you can outsource a lot of the resources. There are some very, very good, outsourced sales firms and co-packers. And you can outsource almost any expertise in this business right now very well. I don't know what my timing is like here, Carol. I don't have a watch. 2 minutes left? Oh, there we go. Okay, sorry. Oh, 7. Good. Awesome. Thank you. Okay, so so how do you prove all this to investors? Well, you have to let the numbers talk for you. And there's so much data and there's so much numbers available now, and people are really tuned into it. The bar is higher. 5 years ago, people didn't look at IRI data even the way they do now. And it's a lot of the same data, but people are just doing so much more with it. When we sold Blake's to Conagra, they walked in the room and they knew where 70% of our new customers were coming from. It was from their banquet pot pies. We didn't even know that. I mean, that's 7-figure IRI expenditures to get that level of data, but it's out there, and people find this stuff out. So the more that you know, the better. So when you think about numbers with investors, who are you? How did you get here? So what's your revenue growth rate, capital efficiency? What's happening? The run rate, pipeline fill? How big can you get? Know your market. And don't say snacks are a $100 billion category. It's maybe barbecue sauce is an $800 million category, and I can get 10% share, and here's how I'm going to get there. That approach. And then how much will it cost me? So where do you raise money? So if you're, and this changes all the time, but if you're looking for $1 million or less and you're pretty early, the first thing that you're doing is you're raising from yourself, you're raising from your friends, you're raising from Aunt Phyllis, and hopefully you're not going to lose her money and you feel a little guilty about it, right? But she gave you a lousy Christmas present as a kid, so that's okay. And you're raising from people that you used to work with in your past jobs, other close networks, right? But at some point you tap that out. And then you have to say, okay, well, what do I do now? And at that point, you're going to angel groups, accelerators. There's a bunch of people in this industry that have made money selling their companies that are looking around for board positions. And they'll drag their friends in with money, and they have money, and they're happy to jump on and help out. There's kind of all different ways, but you're not raising money from an institution yet. You really need to be kind of $5 million or higher in revenue to do that, for the most part. And it varies a little bit. So there's this tweener stage that happens. You get your board member in, you raise your $1 million, and you're at $2 million in revenue. And you're trying to say, well, how do I get to 5? Because I need another $2 million. And fortunately, right now, there is a bunch of family offices and kind of smaller institutions, and quite frankly, some individuals that have made a lot of money on their sales that are filling that gap. In 2009, it was almost impossible to touch that. It was really, really difficult. But that gap is being filled right now. It's hard money to raise, but it is there. The key is to be able to prove that you're going to make the $5 billion with everything we've talked about here, that you know how to get a customer to try the product, they're doing it, and your velocity is going up. And ideally, you're starting to move from natural to conventional if you started in natural. Like 1 or 2 conventional cases is wonderful. So actually, I think I just covered a lot of this, but this is kind of the next phase. Once you get to $5 million, then you're looking at the big growth firms. And you're looking, these funds are getting bigger and bigger. So, VMG now, a few years ago, they'd write $10 million checks. Now they'd love to write 20 or 30. TSG, they were writing $20 million checks. Now they want to write 50 or more. They're doing deals like Planet Fitness, which is, multi-$100 million checks. So these groups are getting bigger, but the good news is that if they're getting bigger, they're looking bigger, and you can convince them that at $5 million in revenue, and a lot of companies do this, that you're going to be a $100 million company, you can economically get them to put $20 million behind you. It might be in multiple checks, but you can do it. And you're seeing these deals happen a lot, or even 10. And 10 million is usually where the check size starts at this point. There's a smattering of names there, but there's probably, 75 to 100 kind of value add, investors that are out there, and more popping up every day for the sector. And then profitability, and this is, honestly, when you get to kind of 30, 40, 50 million in sales, it's very hard to stay independent because there's such a demand to buy the companies at that point. It's almost impossible to actually get to profitability unless for some reason, you're in a category where, somebody doesn't want to buy you, or it's almost rare. It's really, really rare. Skinny Pop is about the only example that I can think of that got really, really profitable and really, really big. And they were bought by a private equity firm that was going to do a roll-up. Probably because they had so much EBITDA, they got a better price. I mean, it's just a different story. So, how do these investors value you? And I know a bunch of people here. I bet if I did a show of hands, I bet at least a quarter of you guys have had a finance class, maybe a half, and you learned all this really great theory about discounted cash flow and comps and all this stuff, right? Well, that's like all out the window now. That's gone. There's none of that, right? I wasted my time. What they do is they say, okay, I think this company can sell for $90 million with the money I'm putting in. And they take your model, and then they create their own model based on yours. It's usually a haircut, because everybody's pretty optimistic on their company, as you should be. And they say, okay, well, if I have $90 million that is going to sell for, and I put 10 in, I need to triple my money. So I need to get 30 somehow. So I need to make sure that when I look at your pre-money today, if I'm putting 10 in, that I can make 30 on 90 or get a third of it. So when I look at your pre-money, it would have to be 20 to add my 10 million gets to a post-money of 30. I have a third of your company. When I sell you for $90 million, I triple my money. So that 3x is just about where every single growth equity investor, call it the $5 or $10 million checks and higher, that's how they're figuring out the value of the companies. If you're earlier stage, if you're dealing with family offices, you're 2-5 million, something like that, it's probably more like a 4x, because they know that you're going to go get more funding and more dilution later on, and there's more risk. There is no fancy financials or PhD in statistics. It's honestly your projections and what you're saying and how convincing you are is going to drive that value at the end of the day, and how much you have to support it. That's really it. It's our last slide. So I'm good. I'm 38 seconds early. Any questions? We have 20 seconds for a question if anyone has one. We got one.
Excuse me, Miss.
I can email it around. Carol, do you guys provide those?
Sorry, what?
Do you guys provide the PDFs of these things?
Yeah, you'll receive an email after the event with links to all of these slideshows from today, from tomorrow. They'll also, the discussion tomorrow will also be on YouTube after. Any other questions? If not, I know you'll be joining us at a round table and sticking around tomorrow, so available for lots of questions.
Cool. Thank you, everyone.